Let's get a closer look at credit ratings in private debt. Patrick William from Rixon Capital joining me now. So we are probably seeing a lot of demand at the moment, given the uncertainty that you're seeing in public markets.
Yes, that's right.
So tell us what you're seeing.
So while there's a lot of demand for private credit, it has become an increasingly competitive sector for capital. And what we've observed is funds beginning to use shadow credit ratings rather than credit ratings from licensed rating agencies like S&P and Moody to enhance the optics of the underlying credit. And our position is that's actually quite problematic, and we think that's something ASIC should and will end up looking at.
So what are some of the red flags people should be looking out for?
So if you take a step back, you look at a standard the traditional credit rating, what you think of is a Moody's or an S&P, licensed, large. They've got an underwriting formula that's known to the market, and they've got a brand that they're looking to protect. So if you see a credit rating that does not disclose where the rating came from, or it's disclosed as an in-house rating or a shadow rating, beware.
So can you tell us a little bit of a difference then between the traditional and some of the shadow ratings?
Yes. So the reason private credit in general don't use the mainstream ratings, S&P and Moody, is they're very, very expensive. It's a few $100,000 to get started, and it's a few $100,000 a year to keep it going. So it tends to be limited to very large corporate issuances or securitizations, large and multi-year. And that's perfectly fine. So with the shadow ratings, it's done at a much lower cost. It tends to be done by an organization that is not named by the fund manager. So there's no reputational impact. And the incentives become skewed because you can shop for a rating then. Right? Someone says, I'll give you a AA. I'll say, well, someone else will, if I pay someone else, they might give me an AA+, which enhances my product. But the quickest red flag is if the rating is high and the returns are very high as well, that should be something to look out for, because high ratings mean high credit quality, which translates to a lower risk-adjusted return.
All right, so if we talk more broadly then in terms of some of these misleading risk-reward scenarios, can you give us an example?
Yeah, so without naming funds, so there's the funds out there that say, look, we've got an investment grade proposition. Our portfolio is investment grade. Here's a pie chart with double A's and double B's, which are very, very attractive, but they're delivering 8, 9, 10% returns. That's not possible. An investment grade Australian corporate bond or piece of corporate debt yields no more than 5.5 to 6%. So how can you be generating these really high returns with these apparently extraordinary ratings? So that's a red flag. And it's very unfair to investors because they make those allocations trusting those ratings they see.
All right, and just more broadly, let's talk about where you're at in terms of the demand and interest you're seeing in private markets.
Demand is strong.
Yeah.
We're seeing ups and downs because I think people were a bit more optimistic about the equity markets maybe 4 weeks ago. And you could actually see that little bit of pullback where the wealth managers say, look, we're actually beginning to get back into the equity markets. Hopefully that is reversed. But by and large, right, the Australian private credit market is still nascent. And as long as it's nascent, you're still going to get that higher risk-adjusted return than in a mature market.
And I know you've been on the road a lot too, Patrick. So what are sort of some of the conversations and interest levels that you're seeing when you're out on the road speaking to people about private markets?
Lots of questions.
Yeah.
I think there's this has been going on for a while, but people are asking harder questions about what our underlying assets are, what our ranking is within the debt structure. So we've come a long way. 24 months ago, people shopped returns. You do 15, I do 10, so 15's got to be better than 10. Whereas we're seeing that sophistication where people go, that return looks good, now talk me through that underlying risk.